it's a good opening for the market. In fact, picking up pace as we speak, and stocks like Sun Pharma are in a league of their own. For that stock has gained about 11% in just 2 trading sessions. Not even 2 trading sessions. That's the kind of ferocity which some of these large caps are moving. But what will the Reserve Bank bring about today? Are we in for the 3rd rate cut this year? Joining us now is our market master for the day, Nilesh Shah, Managing Director of Kotak Mahindra Asset Management. Nilesh, hi, good morning. Good to see you. And as always, the last 2 speakers we've spoken to this morning indicated that there is a high probability of a rate cut today. What's your own sense?
So, there could be different kind of rate cuts. One could be repo rate cut. I think the possibility of that is probably low. The second could be the CRR cut. The possibility for that probably is higher. The third could be the cut in the corridor itself. Today the difference between reverse repo rate and MSF is 2%. Can that corridor rate be reduced by 1%? Probability of that is again low. So we are in a spectrum from repo rate cut to corridor cut to CRR cut. My feeling is that possibility of CRR cut is higher. Possibility of those 2 things is little lower.
Okay. Hi Nilesh, good morning. At least when they got the last, rate cut, the surprise one in the early part of March post the budget, it was an anti-climax session. The markets rose and then they fell as sharply as they rose. Let's work with the 3 scenarios that you've laid out. A low probability event of a repo rate cut. What will be the market expectations? If, in case in the second scenario, we get purely just a CRR cut, how do you expect the markets to, react to that? And thirdly, if we get a cut in the corridor.
The fixed income market's behavior will be different from the equity market behavior. The fixed income market, if they see the signs of either the repo rate cut or the CRR cut or the corridor cut, probably then will try to realign market yields in line with the policy rates. So 25 basis point rate cut in, let's say, repo rate, or probably 50 basis point rate cut in the corridor, or probably 50 basis point rate cut in the CRR, should be able to nudge market yields little bit on the lower side. Now already in last 5-6 sessions, the market yields have moved down by about 7 to 8 basis points. So to some extent, some of this softness is already priced in. But going forward, I think the market yields can still go down, provided one of the 3 scenario develops. From the equity market point of view, clearly bank index has been a big outperformer over the market over last 1.5 year. And from here onwards, they will be more focused on the asset quality. They'll be more focused on the capitalization of the banks, especially PSU banks. And hence probably the reaction of the equity market towards this policy rate cuts will not be as aggressive as that might be there in the fixed income market.
Okay, fair enough. What about the trigger for the equity markets as a whole, Nilesh? We saw some respite yesterday because of the fact that the jobs data in the US was weak and the possibility of the Fed hiking rates will be later rather than sooner. For our own markets to move higher, what do you think the big trigger could be from here on?
I think the market now can be driven by the earnings growth. We have seen last year PE ratio expanding from 12 times to 16.5 times and earnings expanding by about 5 to 6%. Clearly, the scope for PE ratio expansion is limited. The earnings growth will be the biggest driver. Earnings growth over next 12 to 18 months will be enhanced if capacity utilization picks up, if interest rate reduction happens for the borrowers, if the inventory losses which are getting written off in their quarterly results right now starts getting reflected by way of lower raw material costs into their margins or into the volume. So it's a combination of overall pickup in the economy which will be essentially translating into better operating leverage for India Inc. and that resulting into better earnings growth.
Nilesh, so far in the last few months, the markets have clearly rewarded, growth stocks or quality stocks over, value. In FY16, do you think this trade will continue? Will, the growth stocks continue to see higher valuations and, over the value stocks? So that trade will now shift towards the lower valuation, potentially high growth stocks.
I think, that's a very, very interesting observation. And clearly we see in some of the quality stocks where lack of supply has kind of kept valuations and prices at elevated level. I don't think so this trend can sustain for a long period of time, so it is very difficult to predict when it will end. My feeling is that some of the quality stocks will take respite at current level of prices and valuation, and then they will allow earnings to catch up with them. So there will be a time correction in this portfolio of stock. Clearly, lack of supply is resulting into sustaining of these valuations at current level. Then there is also so-called value stocks where there are many companies which are still trading below book. They are especially in sectors like real estate, metals, or PSU banks, and so on and so forth. My guess is that unless until policy changes happen, which will be able to push up significantly this sector's fundamental, these stocks are not going to deliver return. So we are then left with moderately valued stocks where operating leverage can kick in, where earnings growth could be higher than their PE ratio. Now this can be defined more potentially as growth at reasonable price kind of bucket. So my feeling is that neither the value nor the growth will be a big outperformer next year. It's growth available at reasonable prices, at reasonable valuation, that should be able to deliver better return.
Okay, fair enough. So if someone had a good enough risk appetite for the next couple of years, Nilesh, what should the investment strategy be? Should you be 100% invested into equities? Should you also increase exposure into debt funds? What is the recommendation now to retail investors?
So today, in some sense, you have opportunities on both the hands. The fixed income market, courtesy the softer interest rate policy over the next 12 to 18 months, should also be able to deliver good return relative to their risk return profile. The equity funds are more likely to deliver returns in line with the earnings growth, and we do expect FY17 earnings growth to be 20% plus, whereas FY16 earnings growth could be little muted. So you have an opportunity to earn good returns in equities as well as fixed income, and depending upon your risk profile, one should take a call whether he wants to remain invested in equity, whether he wants to come to the fixed income funds. In fixed income funds, we'll recommend picking up duration if you are comfortable with little bit of volatility. So the longer ended gilt funds, longer maturity corporate bond funds will be ideal investment. On the equity side, our recommendation will be to go towards more large cap stocks, more large cap funds, as the difference between mid cap and large cap valuation is very, very narrow. So over next 12 to 18 months, the large cap and a blend of large and mid cap funds should be able to outperform the market.
You indicated in your earlier answer that the trigger for the equity markets will be the earnings growth going forward. How do you expect Q4 earnings to be? Is it going to be as bad as what we saw in Q3? And are we likely to see shaving off of the FY16 or FY17 earnings growth expectations?
So quarter 4 earnings are likely to be as bad as quarter 3 earnings. There are, even defensive sectors like technology where earnings could be under trouble because of the sharp appreciation of rupee against currencies like euro and yen and GBP. So even the safe haven sector of the technology probably will not be able to provide earnings growth this quarter as much as market was earlier expecting. We are even seeing consumer staple and FMCG sector getting restricted on their earnings growth because of the slowdown in rural economy. So quarter 4 earnings are unlikely to be different from quarter 3 earnings. However, in FY16 earnings growth, where the street is between 15 to 19%, I think there will be little bit of moderation and street will veer towards 12 to 15% earnings growth. However, as I mentioned earlier, it's the FY17 earnings growth which will be crucial. That's where you will see full pickup of capacity utilization. That's where you will see full advantage of interest rate cuts. That's where you will see advantage of lower working capital cycle. That's where we will probably also benefit from the better margins either due to volume pickup or due to lower raw material prices. So FY17 earnings growth could still be upwards of 20%, And I don't see that earning trajectory getting impacted by Q4 earnings.
Okay. So then if I want to take advantage of this, the fact that FY17 earnings will be as strong as 20%, what are the funds that I should invest into now? The funds that perhaps have exposure to higher cyclical sectors, infrastructure, capex related sectors that will, lead the up move?
So my recommendation will be not to divide, sectors into cyclicals and non-cyclicals kind of thing, or linked to infrastructure and non-infrastructure kind of thing. As I mentioned earlier, the portfolio of stocks which will be growth at reasonable price, where earnings growth will be higher than the PE ratio currently, where operating leverage can kick in, and where as the operating leverage starts coming in, the earnings growth can get accelerated ahead of the market expectation. That's the sector, that's the portfolio of stocks which will deliver return. When last year we saw sharp divergence between the sector returns. So pharma, banking delivered far more return than, let's say, metals and minings and powers and utilities and so on and so forth. Now probably most of the sectors have been re-rated to the extent of their valuation permit. Now they will have to deliver earnings growth, and earnings growth going forward will come more from how you are able to sweat your assets, how you are able to squeeze your working capital. So it's going to be more stock specific story rather than sector specific story. So better to focus bottom up on stocks rather than top down on cyclical versus non-cyclical, or infrastructure versus non-infrastructure.
You indicated that in the near term, even defensive sectors like in IT, could be impacted because of cross-currency headwinds, or perhaps even FMCG stocks could be impacted because of sluggishness in rural demand. In particularly in IT as well as FMCG, is this factored into the prices, or when the earnings come, we are likely to see a negative surprise?
So on a broad basis, the trends of weakness in rural consumption, the cross-currency impacting the earnings on technology sector has probably factored in by the market. However, what has not been factored by the market are company-specific events. And we did see in the month of March couple of large as well as small and mid IT companies coming and lowering their guidance either due to some client losses or due to certain cross-currency events. So to a great extent, all these companies have gone and kind of forewarned the investors. They have prepared investors for the fourth quarter result, and hence I don't see significant material impact on prices despite weak earnings.
Okay. By the way, the market is now losing a bit of ground as we speak, so it's flattened out completely. The index, that is, the Nifty is just holding on with gains of about 13 odd points. And what's come off, apart from BHEL, which was the big loser, down about 1%, many other names like Hero MotoCorp, M&M, Dr. Reddy's, and from the heavyweights, names like ITC, Sun Pharma, etc. In fact, Sun Pharma has now moved into the red, so there's some profit taking that we're seeing. Names like HDFC Bank, etc. are also in the red at this point. So just watch out for the market getting to be very volatile in the last 10 or 15 odd minutes, now absolutely flat. Nilesh, what would you do with the banks as a whole? Because, the PSU banks have been one of the worst performers this year. This on the back of such a stellar performance last year. So it's confusing, what one should be actually doing with this pocket. Would you stay away from PSU banks and concentrate solely on private? Or do you think after the 20-30% correction that names like PNB and SBI have seen, it's a good time to perhaps get back in?
So in our portfolio, we'll divide, the banking exposure in two parts. One which is more longer term, which is more, let's say, investment oriented. That's where we'll focus more on the private sector banks and NBFCs. Clearly, these are the companies where, their sole focus is to increase shareholder value. They don't get deviated by various other social objectives. On the other hand, there is also PSU banking portfolio, which, are significant portion of the economy, are significant portion of the banking sector. But they also have to face certain constraints which are not imposed onto the private sector banks and NBFCs. It could be related to capital raise, it could be related to social objectives, it could be related to managing NPAs. So keeping those constraints in mind, will have different yardsticks of valuation for the PSU bank. And in a very, very simplistic manner, you have to buy them when they are very, very cheap and sell them when they are cheap. So after the correction, certainly PSU banking stocks are worth looking at it, but it will be far more bank-specific investment rather than sector-specific investment. One will have to be careful in picking up these stocks because in the past they have become value trapped. The valuations have to be really attractive vis-a-vis their real book value rather than reported book value in order to make investments in PSU banks.
Nilesh, yesterday the IT department has issued, fresh MAT demands to the FPIs, for prior years. How much of a negative, is this, retrospective taxation? This is a government which came to power promising, a non-adversarial affair or, a stable tax regime. But since they've come to power, yesterday's MAT demand was there, and also there was this CAN tax issue. Is this going to be a major overhang for, the FPIs and will this be a major overhang on the market, and will this change the way FPIs and FIIs assess India?
So if we see the past, in past several times the income tax authorities had raised IT demand on FIIs, and that resulted into sell-off in the market, correction in the market, and then immediately Ministry of Finance came out with clarification that they are not looking to raise tax demands, and that kind of cooled off their nerves. Obviously the retrospective tax demands, whenever made, creates a scare in the mind of investors. However, what we need to point out to our investing community is that we have a legal process, and where the legal system does take an independent view of the case presented by both investor as well as the government, and they are the final decider or the decision maker in terms of whether this retrospective tax liability is applicable or not. So while income tax authorities are doing their job, we have a redressal mechanism, and I think if we can sit with the FII representatives and sort out this issue amicably, whereby at least retrospectively there is no taxation, but going forward we can settle the way it is fair between both the investor and the government, that will be best for the market.
Alright, Nilesh, we'll leave it at that. Thank you for your thoughts as always, and you have a good day. There's a hectic day lined up ahead, so let's see what comes out.